Christian Menegatti. Before we talk about where you're investing, I want to get your view of the economy. We've gotten better jobs numbers progressively. That said, we got a very weak first quarter GDP number. What should we believe?
Neither. I think GDP, and I believe that's consensus, GDP was certainly affected by temporary factors like strikes in the ports as well as weather. So and there's some seasonal adjustments that probably the Bureau of Economic Analysis will need to review over time. So that's on the GDP number side as well as on some of the releases that are related to it. On the job numbers, I think perhaps on the margin I would believe those a little bit more. So I tend to be positive in the sense that I think that job creation will drive the U.S. economy to stronger growth in the next few quarters. However, it's also true that once we look at the details, there's no wage inflation, or at least not much yet. A lot of those jobs are temporary, so they're not jobs that can necessarily induce some wage inflation over time. I believe that notwithstanding the 200,000 plus headlines over the months, there is still quite a bit of slack in the economy. So the unemployment rate is probably not exactly the right measure when one thinks about slack. So one has to look a little bit holistically at the labor market in particular and not just at the employment numbers in this case.
Well, we did get a little bit of inflation in the April core CPI, beat Wall Street's estimate. I think it was about 0.3%. Is this enough to get the Fed excited?
Well, it's a positive step forward. It was a surprise, which means that probably the street was thinking that the strong dollar that we have seen throughout the course of the last few months still has to somehow affect or be included, priced into those inflation rates. So there is a chance that the strong surprise in core inflation might not be necessarily yet sustainable. Let's say, type of number, type of surprise. However, I think we're moving in the right direction. As I said earlier, job creation is a positive sign. Eventually, we'll get to the point in which the labor market will be a little tighter than what it is right now, and we'll see some wage pressures, and therefore that will translate into core inflation and hopefully some headline as well, given the moving commodities.
Well, we have seen the 10-year Treasury yield tick up from about 1.7% in January. Now it's around 2.3%. It's really been moving higher over the past week. So give me your outlook for fixed income, putting all that we just said together.
Okay, so first of all, I would say, given your premise on the Treasury, the 10-year ticking up, I would say that 10-year Treasuries are driven not just by domestic factors, by the Federal Reserve, by GDP and inflation, but they are driven also by global factors. So what is happening in other parts of the world where central banks are actually easing as opposed to tightening, cutting rates as opposed to raising rates, that is affecting the Treasury market. The Treasury market is also notoriously a safe haven destination for flows, and there is plenty of risk out there that can induce risk aversion and safe haven kind of seeking behaviors from investors. So I would say that if we think about hopefully a recovery in nominal growth, so real growth and inflation, Treasury yields might tick a little bit higher from here on the 10-year. However, I think that most importantly, when thinking about the beginning of a rate hiking cycle, the beginning of the Fed tightening, so raising rates, I would say that one should take quite a constructive approach, a barbell approach we call it, right? Where if you agree that you need to have some domestic fixed income in your portfolio for risk management purposes, you are better off dedicating a part of that fixed income sleeve of your portfolio to longer maturities, okay? And that's because you can benefit from safe haven flows when those happen during risk aversion, and also because the yield curve tends to flatten during rate hiking cycles. We've studied 18 rate hiking cycles, and a steepening of the yield curve across the cycle is an exception rather than the rule. So that can be an approach that can be constructive, not despite the Fed, but because of the Fed hiking cycle.
And then what about on the equity side? What's your outlook for stocks? We had the S&P 500 at record highs this year. Yeah. Too pricey?
I wouldn't say, I'm going to shy away from comments on whether it's too pricey or not, because the outlook is, there is so much uncertainty. There is one thing that I think is very important to note, right? not only volatility is back across asset classes, including domestic equities, and that's something that, of course, makes diversification, not just being in equities, but also away from equities and away from domestic equities important, right? But the other point that I would make is that other central banks in the world, if we look for opportunities in equities, are following the template that the US has followed in the past 5 years. So they are essentially injecting liquidity into their economies with the purpose of reflating assets. And of course, I'm alluding to the Eurozone, and I'm alluding to Japan in particular. So there has been an outperformance of international equities ever since these programs have started.
And do you expect that to continue? So are you more favorable on, for example, European, Japanese equities than the US right now?
I would say that there are still definitely opportunities in the international equity market, and I would say that a tilt towards those markets is warranted at this point still.
All
Absolutely.
Right. Thanks a lot, Christian.
Well, nice talking to you.
And thank you for watching The Street.